Hey everyone, Harvey Steele here, responsible for the intermediary business at Westwood, Salient, and Broadmark. Wanted to share some thoughts with you today because I spent the last 10 weeks on the road, spending time with broker-dealers, RIAs, and financial advisors, as well as allocators across the country, and the feedback I'm hearing is overwhelmingly consistent. By and large, people are telling me three things today. They're saying, Harvey, the market's expensive, earnings are falling, and this is especially true if the consensus view of an imminent recession is correct. Next, they're saying, Harvey, something could break. Was it, or is it going to be the banks? Could it be parts of the real estate market? Maybe we haven't seen the worst of this yet. And then the third thing they're saying is, Harvey, cash yield's over 4%. It's a great place to wait. I get it. Cash is absolutely a legitimate asset class again. I'm not going to argue that. I get it, but here's the thing. None of us can definitively tell you when, if, or how a recession will start. We all have opinions, and consensus less than a year ago was that the recession would have hit in 2022. We would all love to have a clearing moment, ring the bell, and pile in. That doesn't really happen. Here's what we do definitively know though. First, a market is not the market. And second, the market is changing. When I hear people say the market, they're typically talking about the S&P 500, a massive cap-weighted index. So let's take a look at the S&P. Two stocks, both mega cap tech, make up around 12% of the index. That's 2.5 times the weight of the entire energy sector. They contribute about the same contribution to S&P earnings though. So to put it another way, the energy sector is trading at around a 60% discount to these names. A cap-weighted index is not a broad market. So let's look around the broad market. Mega caps, almost entirely driven by 7 tech stocks, have rallied to recent highs while the other 493 stocks in the S&P 500 are on average down year to date. Earnings in these 7 names have not been blowouts. These names have just been getting more expensive. Conversely, small cap stocks are trading near their October lows, and micro caps are trading near 52-week lows. These names have gotten cheaper, with many at a single-digit PE multiple. We have all witnessed a banking crisis in recent weeks. Financials have been severely punished. Weekend closed-door meetings and Sunday night announcements are a thing again. Throughout, we've heard quite a bit about liquidity in Treasury, agency, and mortgage paper. Let's be honest, when the Fed needs to step into these markets, it's not great. Let's not candy coat it. Banking regulators may have been stress testing the wrong thing, or perhaps not accounting for a Fed this active. We also know that access to credit has tightened. Loans are much more difficult to come by than they were a month ago. We also know that leading indicators of a credit crunch are out there. Subprime delinquency rates are rising. The collateral in some loan books is deflating. Used cars are a prime example. Office real estate in some markets as well. And there are businesses out there that do not generate positive free cash flow, that are highly levered, and will need to roll or refinance their debt at potentially much higher rates than before over the course of the next few years. These businesses may have real issues. Some businesses will need help, some loans will be restructured, and some businesses will be sold. It's possible even that the Fed steps in again. Surprisingly, although mortgage spreads have widened in recent weeks, high yield credit spreads have not really blown out yet, although many investors believe that it will. It's scary out there, I get it, but the market is changing and you can take advantage of it. I'm absolutely not telling you to ignore the noise and jump into risk assets, but I am asking that you consider a few other things that we do definitively know. We know that a lot of companies were prudent and they took advantage of all-time low rates. They recapitalized their businesses if they needed to, and they locked in attractive fixed-rate financing. We also know that many of these businesses generate a lot of positive free cash flow. In fact, more than they have in many years. And the funny thing is, these quality businesses are cheap, both compared to the S&P and also to historical average. Again, some trade at single-digit PE multiples. We have ideas and would love to speak to you about them. We can talk to you about high-quality businesses with low leverage that generate significant free cash flow and trade at huge discounts to the S&P. We can talk to you about energy infrastructure, where companies are in the best shape they've been in years. They're buying back their own stock at record rates and are generating enormous positive free cash flow. We can talk to you about bottom-up multi-asset investing across the most attractive parts of the capital structure. We can also talk to you about directional exposure, both long and short, in volatile markets. And finally, we can talk you through public real estate, what's attractive and what's not. These are all active ideas though, and it's important to note that you're not going to own much of these if you buy a cap-weighted index. And as I said now a few times, please remember, the market is different than a market. and the market is changing. Be a part of it. We'll love to connect with you and continue the conversation. If you would like to speak with one of our market leaders or to me, please reach out to us at westwoodgroup.com or 800-994-0755. Hope to talk to you soon.